In terms of what the market's pricing in, I think there's been a significant reduction of US dollar short positions heading into this Fed meeting. We do have to remember that they are expected to announce the start of that balance sheet reduction. But I think more importantly, the market's a little bit wary about what the Fed's going to do with its dot plots. There are expectations that, given the softer wages growth data and the softer US inflation data, that they're going to lower those dot plots. And the market, well, it's already a fair bit below the Fed when it comes to rate hikes and those dot plots. So that's going to have a big FX market impact. And I think the market's clearing the decks a little bit for that.
What kind of impact then, Dave? Because the market at its most pessimistic level seems to be pricing only one rate hike between now and early 2019. Even if they bring down the dot plot from, let's say, 3 to 2, that's above the market pricing. So how will the dollar react, considering short positioning is at its highest, speculatively, since 2012?
Well, as I was saying, I think the US dollar short positioning's been wound in a little bit. You're absolutely right. The IMM data suggests that it was a large short position. I think that it really will depend on how the Fed words it as well. If they did reduce their dot plots by only 25 basis points and then continued to sound resiliently hawkish or moving rates towards normal or neutral, then that would probably see a bit of a spike in the US dollar and a push higher in US Treasury yields. But if they suggested it was dovish, or there are concerns more to the downside and hinted that these dot plots could go lower further, then the market could actually read that as validation of their very dovish view relative to the Fed and cry a little bit of victory and start selling the US dollar again. So I think the wording of the Fed will depend a lot as well, will determine a lot in terms of what happens in the US dollar.